And they say macro doesn't matter. The Federal Reserve comes out and absolutely explodes the markets. Stocks soaring, dollar down, gold soaring, yields down. It is a fun day in the wake of the Fed policy announcement. But it's not over, because two more central banks are waiting in the wings to do it all over again. Welcome to Macro Money. This is Ilya Spivak, head of global macro here at tastylive. And we are sifting through the rubble of what the Fed has wrought here earlier today, and find ourselves facing two more critical central banks, this time in Europe, the ECB, the European Central Bank, and the Bank of England, getting ready to have their turn in the hot seat. And of course, the natural question that we ask ourselves here is, are they going to actually move anything? Will this matter? Since we've just had this blistering announcement from the Fed. Now, we're going to take a look at what the makings of the situation are. We're going to take a look at where policy expectations are and what all of this might mean for these meetings, and then settle on what is a tradable approach to dealing with it. So what are some actual trade setups that present themselves here, that these particular policy announcements in the wake of the Fed might generate for us here. So let's begin with the Eurozone, because that is really the pace setter for this situation. So looking first at what's going on there, we can see very simply that the implied policy path has pointedly shifted into a more dovish direction since the last time that the ECB met. You can see the last policy announcement here in the big dotted line. That's from October the 26th. The solid line here and the one from a week ago in the small dots, they are pointedly much lower. So we can see rate cuts starting in earnest sooner. We can see rates coming down meaningfully lower. So no question here that over the course of November, the markets took a much more dovish view of what's going to happen with the ECB. And with good reason. If we look at inflation dynamics in the Eurozone, we can see inflation is already down to 2.4%. That's only a hair above the target of 2%. What's more, we can see that the places where inflation is coming from are not those where the ECB really has much agency. So they might be inspired to do nothing at this point. And of course, clearly, we can see that neon purple area on the chart, that's food inflation. That is by far at this point the biggest contributor. So if we take a look here at what the actual influences were in the very last inflation report, and you can see here that that comports with the trends as they've developed. So it's not a one-off report here by any stretch of the imagination. We can see out of the 2.4%, 1.2, a little bit over, so just slightly over half, is food. Energy is at this point the biggest detractor from inflation. That's taking away about 1.1%. We take those things out because, of course, they've been mainly the kinds of things that the ECB can't do much about. They can't really mandate what the price of internationally traded commodities is going to be. And they certainly can't tell people not to use energy and not to eat food. So there's not a whole lot that you're going to do by raising interest rates or lowering them that necessarily impacts this in any kind of near-term direct way. So if we look at the rest of the pie here, it's quite modest. If half of inflation is food and energy is there on the downside, then you're pretty much at the target were you to take food out of the picture to any kind of a meaningful extent. Now, might you then also take out the influence of energy? Sure, but then you would end up, again, just a hair above target. So the trajectory here seems to go in the ECB's favor one way or another. There's also a good argument to say that you're not going to get a big recovery in energy, and you're not going to get a big recovery elsewhere in a lot of the more discretionary areas of spending here. They're likely to become more of a hindrance to inflation because the economy is ostensibly already in recession. We've already had 5 consecutive months of the economy contracting. Looking at these PMI numbers here, this is, as ever, done in the logic of purchasing manager indexes, where 50 is neutral, above 50 is growth, below 50 is contraction. As we can see here, for the Eurozone, the purple or the sort of bluish purple composite line, that's the one in the middle here that captures what's happening both in manufacturing and in services. It has been below that 50 line now for 5 months. Data that's due to be published at the end of this week is going to keep that there. We can see here the expectation is to get the number at 48 for the 6th consecutive month. So that's not quite a GDP number showing 6 months or 2 quarters of contraction, but it's certainly the kind of foreshadowing that suggests you are going exactly there. So we're effectively in a recession in every sort of way, but in name officially in the Eurozone. So when you look at the contributions from things like, let's say, restaurants and hotels, recreation and culture, they're currently positive additions. They're likely to start to get smaller as that economic downturn punctures more discretionary spending. And of course, it also means that the influence from the energy side isn't likely to be much more of a factor because with a slower economy, there is less demand for energy. Energy is very cyclical. So we're looking at a situation where the ECB probably does not need to do much more. And indeed, the priced-in outlook, as we just saw, has shifted in a dovish direction. And we can see here now the first cut fully baked in to occur in April. So we can see here there is already one full cut that is baked in there. And about a 48% chance for a second. That second is already there by June, and about a 53% chance for a third. The third is there by July. The fourth is there by September. We're approaching a fifth with very high likelihood, 86% by October, which basically means that we're going to get, probably once we get to December, a 5-cut run from the ECB next year. So looking to be down 1.25%, between 1 and 1.25% next year, leaning toward 1.25%. It's a very similar story when we turn to the UK. Also, sharp, dovish adjustment over the course of November. That last meeting was November the 2nd. And here also we can see sharp adjustment down. It's even down relative to a week ago because, of course, here we also had some disappointing GDP numbers overnight. So even just over the course of today, there has been more heaviness in this outlook. And so we're looking for more substantive cuts by far now, and for them to arrive much sooner, about 3 to 6 months sooner. than they were when the Bank of England last met in November. The makings of the economic story, very, very similar to what we note in the Eurozone. Here's the inflation situation here. Again, the biggest contributor is food. Now, of course, at 4.6 on CPI, we are still quite a bit away from the target. Food is the biggest component, but of course, unlike the situation in the Eurozone, where, again, looking at the CPI picture here, 2.4 is less than 0.5% off target. When we look at what's happening in the UK, we are more like 2.6% off target. So, needless to say, more work to be done here. But again, if we look at the make of what's going on here, we can see food, by far the biggest contributor. The other two that really make an outsized impact, recreation, hospitality. So here's recreation, here's restaurants and hotels. Energy, again, something that is pulling inflation lower because energy is down a lot. Take these things out of the equation, and you're looking at essentially a battle for the Bank of England that has been won. Can you do that credibly? Well, the economic situation in the UK is not much better than it is in the Eurozone. Things are not contracting in a broad sense. You've had 2 months of contraction that were punctured by a slight expansion right here in November, and it looks like the pace of that expansion is going to perk up a little bit here, up from about 50.7 to 51. So cautious growth, but almost at standstill here. So very, very tepid economic growth. And of course, that's the kind of thing, especially as rate hikes from earlier work their way into the economy, that's likely to work against spending on hospitality and recreation. That's the kind of thing that's likely to puncture those things. And so when we look at what's going on with this policy outlook, the rate cuts are expected to come a little bit later. There's about an 80% chance that we're going to have something in May, 79 to be exact right here. The full cut is fully baked in for June, and we can see that we're looking at less of them. So whereas for the ECB, we're looking for 5, by November, we're looking at 3 with optionality on 4 from the Bank of England, and this should make sense. Inflation is much higher there. But also, the makings of it are no less vulnerable. And so you arrive then at a situation where you seem to have, because of the higher inflation numbers, less of a dovish baseline for the Bank of England. A later start for cuts and fewer of them, whereas for the ECB, it's a sooner start to cuts and many more of them. Perhaps some of that can be rationalized away because the UK economy is doing a little bit better. As we can see here, 51 on Composite PMI means the economy is growing. As we just saw for the Eurozone, 48 means that it's not. It's shrinking. So maybe that explains how you still have some relatively heady contributions from recreation and hospitality to UK CPI. But the path going forward clearly is one where the growth bias is down, the economy is creaking along with very, very modest expansion, and those discretionary spending categories are likely, against that backdrop, to ease off. So really the question for both of these economies is, should these central banks, now that we've already had this dovish adjustment in policy, should they push back? Should they come out and say, look, we know and we can see what's going on, but until inflation is good and beaten, especially in the UK, we are not going to commit to anything dovish. We are not going to give you policy guidance that endorses all of this rate cut myth-making that you've done. And the reason why these central banks would do that is because they don't want to encourage the markets to take what they say, run with it, unhinge inflation expectations, and undermine all of the progress that these central banks have made over the past year, year and a half. So should they and will they push back? Let's consider. So on the question of food, which is the biggest contributor to inflation at this point, as I say, the influence here is primarily a given for central banks. They can't exactly tell people not to eat, and they can't exactly raise interest rates such that people would be crowded out. That is, they would find it too expensive to eat. Eating is relatively fundamental, shall we say. So they have to kind of take the global dynamics here as given. And the global dynamics are encouraging. We can see here in the orange is the UN World Food Price, and in the dark gray here is global CPI. And we can see that the transmission mechanism takes about 7 months. So I've pulled back CPI by 7 months here. I've lagged it by 7 months, and we can see that it lines up very well with the global price of food. So as the global price of food declines, CPI follows about 7 months later. And we can see over here, there is still quite a tail for global food to continue to head lower, and for that to continue to show up in CPI. We can incidentally already see this decline, again with a lag, occurring. So here it is occurring here in the euro area. So it's the biggest component, but it's lower and it's steadily declining. UK, same thing. It's crested and is heading lower already. So at least from this perspective, there does not seem to be an impetus to push back. Furthermore, as we've had all of this dovish myth-making in the market, so as expectations for the ECB have become more dovish, as expectations for the Bank of England have become more dovish, the markets did not run away and say, oh, this is going to get inflation higher. They are going to back away from rate hikes, and that's going to let inflation back out of the bag. We're looking at 5-year inflation expectations here from the swaps market as a kind of catch-all measure for medium-term price growth. And we can see here the markets actually adjusted down on inflation expectations over the past 2 months, even as these central banks are seen introducing more and more cuts next year. So the market looked at this and said, we are going to actually expect inflation to come down, not only in the situation as given, but even with rate cuts. And in fact, as rate cuts grow in the outlook, inflation expectations are going to be lower, not higher. That suggests the market has already told these central banks, you've done enough. The path to disinflation is set. Now, the business cycle is dire enough. Recessionary forces are strong enough. The amount of tightening that's still in the pipeline is enough. You don't need to do more. You can cut rates and inflation will still come down for all the things already at work and for all the forces you've already activated. So it doesn't seem like either the ECB or the Bank of England need to push back, just as the Fed didn't push back. And therein is where the trade seems to be. It was the same calculus when the Federal Reserve met earlier today. The markets gave them a significantly dovish shift in expectations through November around these very similar dynamics. Growth had slowed, inflation expectations were falling even as rate cut expectations were growing. Same message from the markets to the Fed. And so when the Fed came out earlier today, what they said was, right, we think that rates are probably at this point done rising. We're looking at the forecasts, something like 75 basis points in cuts next year, which they'll be expected to revise higher to come in line with the market's own forecast. And so we're seeing a Fed that really leaned into the market's dovish inclinations. The result, a much weaker US dollar. Here we have the euro future, and we can see that was the response from the Fed. Again, please tell me that macro doesn't impact markets. Here was the Fed and its influence on the euro. Unmistakable. The dollar got hammered, and that makes sense because the Fed endorsed a dovish view on rates, and when interest rates decline for an economy, that's usually bad for the currency. It was much the same story for the British pound. Right here again, here comes the Fed, and we get a massive dollar sell-off, which comports with the dovish bias, and the pound soars. And therein is the trade opportunity. If the ECB and the Bank of England do the same, do these moves still make sense? Does it make sense that the euro is rallying against the pound? Does it make against the dollar? Does it make sense that the pound is rallying? Both of these currencies are facing central banks that are likely to do much the same thing as the Fed, and at least in the case of the Eurozone, to cut sooner and perhaps to a greater extent. If we look at where rates are expected to end up in the euro area within a year's time versus in the US, they're going to be lower in the Eurozone, looking at the main outlook for markets here. And it's a very similar story in the UK, although by a smaller margin. So as we look at this then, the situation seems to be that these currencies might well be off sides. So the trading implication might well be that what this Fed-inspired move has done in the face of almost certain follow-on to some extent from the European central banks. Obviously, there's all kinds of uncertainty around what they will say exactly, how much of that is already in the market. But as we learned from the Fed announcement today, things can be already baked into the market. And all the Fed had to do was acknowledge them and not push back on them. And here was the response. If this is how this works for the euro and the pound, when the ECB and the Bank of England say very similar things, as they appear likely to do, then we end up with a situation where these currencies are going to come back in. Because whatever yield differential widening inspired this is likely to get unwound when the other central banks say basically the same and signal that they're not really going to let a meaningful widening against the dollar occur in yield spreads. So against that backdrop, fading the rallies in the euro and the pound after the Fed seems like an attractive setup. And that is macro money for today. As ever, we are here Monday through Thursday, right after overtime, a show that I co-host with Chris Vecchio and Dylan Radigan, where we look at what happened at the Wall Street close and what it might mean going forward. I'm back on with Chris for Futures Power Hour on Fridays, on with Tom and Tony for First Call on Sundays, writing for the News and Insights section of tastylive.com. As a matter of fact, this analysis is summarized there and published already. And opining on the platform formerly known as Twitter, at Ilya Spivak. Thanks very much for joining, everybody. See you tomorrow.